Ladies and gentlemen, welcome to the Q4 FY23 earnings conference call of Lumax Auto Technologies Limited. A disclaimer: this conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements do not guarantee the future performance of the company, and it may involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on a touch-tone telephone. Please note that this is being recorded. I now hand the conference over to Mr. Anmol Jain, Managing Director of Lumax Auto Technologies Limited. Thank you, and over to you, sir.
Thank you. A very warm welcome, ladies and gentlemen, to our Q4 and FY23 earnings conference call. Along with me on this call, I have Mr. Deepak Jain, Director, Mr. Sanjay Mehta, Director and Group CFO, Mr. Vikas Marwa, CEO, Mr. Naval Khanna, Corporate Head Taxation, Mr. Ashish Dubey, CFO, Ms. Priyanka Sharma, Head Corporate Communications, Mr. Ankit Thakral from Corporate Finance, and SGA, our Investor Relations Advisor. The results and presentations have been uploaded on the stock exchange and the company's website. Hope you were able to view the same. I would like to begin this call with some insights on the economy and auto industry, followed by the operational and financial performance for the fourth quarter of FY23 before opening the floor for questions. India's growth post-COVID-19 has been phenomenal. The estimates coming from various agencies are projecting a GDP growth rate of approximately 6.5%, which is the fastest in the world, and will contribute close to 15% in the global growth. The economy is thriving thanks to a combination of structural and cyclical factors, resulting in India continuing to outperform its global peers and defy recession. Talking about the auto industry, we have seen a good recovery on back of tremendous resilience, innovation, and robust market demand. The government's continued efforts to make India a global manufacturing hub for automobiles brings out a lot of growth opportunities for the leading auto ancillary companies like us to tap advantage. Be it the PLI schemes or scrappage policies, the growth opportunities are immense. Improving per capita, especially in the urban and semi-urban markets, and the launch of more feature-loaded models are nudging consumer preference towards executive and premium vehicles. On the passenger vehicle front, the trend is now shifting from sedans and small cars towards SUVs, with the share of latter set to increase at a rapid rate going forward. India's passenger vehicle sales grew by 27% for FY23, with easing chip shortages and improving supply chains globally, leading to new launches and better availability over the year. Commercial vehicles saw a high growth of 33%, registering sales of 9.4 lakh units in FY23 compared to 7 lakh units in FY22. With government spending on infrastructure at record highs, this segment is expected to see a good growth going forward. Two-wheeler sales also saw a growth of 19% for FY23, with rural economy showing some signs of revival. Consumer preference is more skewed towards higher CC models compared to entry-level models. Coming to our recent inorganic partnership of IAC India, which is a Tier 1 interior systems and component supplier to key automotive OEMs in the country, including Mahindra, Maruti Suzuki, Volkswagen India, and Volvo Eicher commercial vehicles, amongst others. We have successfully completed the acquisition of 75% stake in the company in March this year. With this, we are now able to jump on the opportunity to combine our competitive strength across products and offer comprehensive solutions to our customers. With multiple synergies coming into play that brings opportunity for new customer additions with cross-selling of products would be the key driver of growth through this venture. Our key growth strategies with IAC will be to diversify and expand business with new customers, to penetrate deeper into existing customers, to unlock product synergies between lighting and plastic interior systems by leveraging the technical expertise of Lumax and IAC, leverage IAC India's strong engineering center to design, develop, new and innovative technologies and products, operational synergies across manufacturing excellence, capacity utilizations, and procurement, and target to achieve higher revenues from EV platforms over the next 3 to 5 years. The ISE management team, along with Lumax, will certainly continue to drive the business going forward. Let me now move on to the operational highlights for this quarter. During the quarter, we have made the following new launches. In the passenger vehicle segment, the gear shifter system for Maruti Suzuki Fronx and Jimny models, seat frames for Jeep Meridian, for two-wheelers, chassis and frames for Bajaj Pulsar 150 twin disc model, and in the commercial vehicle segment, we have been able to add telematic parts for the truck and buses for DICV, the Daimler India Commercial Vehicles. Lumax has been outshining itself through various awards pan-India across categories. This year, our Pantnagar plant received the Super Platinum Quality Award from Bajaj Auto at the Bajaj Auto Vendor Association Convention in January 2023. The Bengaluru plant won the Bronze Award for Excellence in Manufacturing, very large category, at the ACMA Atmanirbhar Excellence Awards held in March 2023. And Lumax Mano Allied Technologies, the subsidiary company, has proudly received 2 awards in the categories of Inner Part Localization and Value Analysis at the Maruti Vendor Conference in May 2023. With continuous new launches by the OEMs, we have also been able to grab new business. Our content per vehicle has increased due to our presence across multiple product categories and long-standing relationships with all major OEMs in India. On the financial front, our consolidated revenues for the full year grew by 26% on year-on-year basis and stood at rupees 1,847 crores, the highest ever in the history of your company. Our EBITDA stood at rupees 224 crores, up by 37% year-on-year, with an EBITDA margin of 12.1%, which has also been the highest ever. This includes financials of ISE India from 10th March 2023 onwards. Our growth, entity-wise, has also been tremendous. Stating out a few, the standalone entity caters to integrated plastic modules, the aftermarket business, the chassis and swing arm for two-wheelers, trailing arm for the three-wheelers, and the two-wheeler lighting. The standalone entity has contributed 68% of the total consolidated revenues for FY23. During the quarter, the company received requisite approval of amalgamation from Honorable NCLT for merger of Lumax Metallics Private Limited with effect from April 1, 2022. Thus, the financials of Lumax Metallics have been merged with the standalone entity. Lumax Mano Allied Technologies, the 55% subsidiary which manufactures manual, AMT, and AT gear shifter systems and has the market leadership position, contributed 16% to the total consolidated revenues. The company has also recorded its highest ever revenue, crossing rupees 300 crores for the first time on the basis of both the value and volume increase, coupled with commencement of manufacturing operations at Bangalore and exports for a global platform. Lumax Cornaglia Auto Technologies, the 50% subsidiary, manufacturing air intake systems and urea tanks, commanding 100% share of business with Volkswagen and Tata Motors, contributed 7% to the consolidated revenues. The joint venture has also recorded a handsome growth at 36% for the year and holds a strong order book and is very bullish for its performance in the next year. Lumax Alpine India Private Limited, a 50% subsidiary for the manufacturing and sale of electric devices and components, including software related to the automotive industry, contributed 2% to the total consolidated revenues. We have aggressive growth plans for this JV in the coming years. I'm happy to share with you that your company is sitting on a healthy order book of around rupees 900 crores. 90% of it is in new business, and out of which approximately 90% is in the joint ventures and subsidiaries. Now I would like to hand over this call to Mr. Sanjay Mehta, Director and Group CFO, to update you on the operational and financial performance of the company.
Good afternoon, everyone. I will brief on the operational and financial performance for Q4 and 12-month FY23. For FY23, integrated plastic modules contributed 26% of overall revenue, followed by aftermarket at 20%, fabrication at 13%, gear shifter at 16%, lighting products at 8%, emission at 7%, and others at 10%. Two and three wheelers contributed 37% to overall revenue, passenger car at 29%, aftermarket at 20%, CVs at 9%, and others at 4% for FY23. For more detailed operational highlights, please refer our investor presentation uploaded on the exchanges and company's website. With respect to financial highlights, the consolidated revenue was at rupees 493 crores for Q4 23 as against 417 crores last year Q4, up by 18%. Q4 FY23 includes revenues from IAC India to the tune of 51 crores from 10th of March 2023. For FY23, consolidated revenues were at 1847 crores, up by 23% over financial year 22. EBITDA margin stand at 12.6% for Q4 FY23 as against 11.8% for QY FY22, up by 80 basis points. Absolute EBITDA for Q4 23 stood at 62 crores, a growth of 26% on year-on-year basis. Absolute EBITDA for FY23 stood at rupees 224 crores with EBITDA margin at 12.1%, up by 130 basis points from EBITDA margin of FY22. Q4 and 12 months FY23 includes EBITDA from IAC India to the tune of rupees 7.4 crores from 10th of March 2023. PAT after minority interest for FY23 stood at rupees 93 crores, which includes profit after tax of rupees 2 crores on account of consolidation of IAC from 10th of March 23. PAT margins stood at 5% for FY23 as against 4.6% for FY22. The capex incurred during FY23 is around 132 crores, which includes 47 crores on account of leasehold assets. Thus, the actual capex outlay is rupees 85 crores. With this, we open the floor for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Abhishek from Dolat Capital. Please go ahead.
Good afternoon, sir, and congrats for acquisitions of IAC India at a reasonable price. Sir, there are a couple of questions on IAC India. So, what is the operating margin of this company excluding other income in FY23?
So, the EBITDA margin is roughly about 16.5%. This is for FY23 full year. That is the operating margin for the company.
So, it also includes the other income. Excluding other income, how much is it?
It includes other income, but that is not the big. It includes.
We will let you know the exact details later, but this one is including other income.
Okay. And what was the PAT number for IAC India for FY23?
Sorry?
What was the PAT number, profit after tax number for IAC India for FY23?
We'll get back to you. We don't have this number ready, but we'll get back to you on the IAC PAT number.
Okay. And sir, regarding the urea tanks, you have started to supply this Volkswagen and Tata Motors. So how much is the current order book and what kind of the growth you are looking from this business? What the norms have changed which will be positive for this company?
So, Abhishek, this is Vikas Marwa. Thank you for your question. Our FY22 sales for urea tanks was about 23 crore rupees, and FY23 we have gone up to about 35 crores. we are expecting growth of 15% year on year minimum on a conservative side for the next 3 years in this particular commodity.
And what would be the margins of this business?
The margins would be high double digit.
It's a high double digit.
High double digit EBITDA margins.
Yes. And there are only 2 players in the country, only one besides us who is supplying this in the country.
Okay. But this business is at very nascent stage and we are expecting a very high growth in this business. But you are saying that is only 15%. As the base is low, don't we think that growth should be at a higher than 50-60% in this business? Because the growth was quite...
We are currently participating in the commercial vehicle segment only. We are planning to expand into the passenger vehicles also for urea tanks, and this is a very quality critical product, being an emission regulated product. We wanted to have this quality parameters right in the first 3 years, so we will now move on to the passenger cars maybe after 1 year or 2 years.
Okay. And in the plastic molded part, how much contribution from the four-wheeler business, sir?
Well, there's a significant contribution. I mean, obviously, it depends what you classify. I mean, ISC is all plastic interior systems as well. But if you talk about the legacy products, there is a decline in the plastic business on a Q4 to Q4 basis. That's primarily because, or Q3 to Q4 basis, that's primarily because of the HMSI volumes going down. But the four-wheeler plastic business with the legacy business is definitely growing, and we've added significant products from Maruti Suzuki in that business.
And how would be the mix going ahead if I talk about only standalone basis of four-wheeler business?
Your question is unclear, Abhishek. Going forward, what are you talking? I didn't understand the question.
So you won the business from the Maruti. So just wanted to understand what is the size of the business and how the mix will change in the plastic molded part in the coming days, because right now that most of the business comes from the two-wheelers only. Going ahead, as the numbers will increase from the Maruti, how will be the mix?
So as I mentioned in my opening remarks, the company is sitting on a 900 crores order book, out of which 500 crores is from IAC, 400 crores is from the other businesses, and out of the total pie of 900 crores, almost 65% of the business is coming from passenger car segment. So that by itself should give you a clear indicator that going forward, the pie of passenger car is likely to move up further compared to what it has already come to. If you look at from the last 2 to 3 years, today in FY23, the passenger vehicle segment is about 30% of our revenue, and two-wheeler, three-wheeler is only about 37%. So it's almost neck to neck. Clearly, FY24 onwards, with consolidation of ISC, this would hugely change.
Okay, sir. And my last question on the aftermarket business. So in last 2 years, the aftermarket business showed a very impressive growth. In this situation, how can we see the growth in coming years? It will be moderate to 8 to 10%, or you will see double-digit growth in aftermarket as well?
I have always maintained that aftermarket, our midterm plan is to double the revenue in a period of about 3 to 5 years. I mentioned this almost 2 years ago or 1.5 years ago. We are on track to achieve that, so you will continue to see a pretty robust growth in aftermarket even in FY24 and onwards. And Abhishek, just to come back to your PAT on ISC, that's 61.5 crores PAT on ISC last year, FY23.
Thank you, sir. That's all from my side.
Thank you.
Thank you. Our next question is from the line of Apurva Mehta from AM Investments. Please go ahead.
Hello.
Yes, sir. Please go ahead.
Yes, sir. Congrats on a great set of numbers.
Mr. Mehta, maybe I request you to use your answer.
Hello. Can you hear me?
Yes, we can hear you. Please go ahead with your question and mute yourself after you ask your question, as this disturbs.
Congrats on a great set of numbers. Just wanted to know your long-term view of our company. Where do you see our company in next 3 years' time? You know, we have a lot of subsidiaries, and can you just let us know each of the subsidiaries, where do you look, because a lot of subsidiaries are not started performing subsidiaries. So when can we see that going on stream, and what is the roadmap of the subsidiary?
So Apurvaji, thank you very much. I think very clearly the standalone entity continues to grow. Even in the FY23, if you see 72% is on the standalone entity. Standalone entity comprises, as I said, aftermarket, I've already mentioned, that will continue to grow at a pretty robust, handsome rate. Apart from that, the lighting business and the plastic business will also continue to grow, largely because of new order acquisitions from four-wheelers and also certain technological changes in the lighting space, which we cater to only one customer, being Bajaj Auto. Now also the metallic being merged into the standalone entity, that itself also will grow. So standalone entity will grow at a pretty double-digit rate, at least better than what it has grown in the last 3 to 5 years. Coming to the subsidiaries, I think Mano and Cornalia, both the joint ventures, are pretty solid in terms of their order book. Mano continues to be the market leader for its product line, and we see a good traction. We have a good order book, so all the way to next 3 years, we see good growth in these two joint ventures. ISE clearly is one which we've just got into. It has a huge upside. It has, as I mentioned, a strong order book of already 500 crores, which they are sitting on, which will get executed over the next 2 to 3 years. And apart from that, we continue to remain in dialogues with other key OEMs to expand our current share and also tap into other OEMs with providing them a value-added solution. So ISE clearly will have its own growth trajectory. And then if you look at the recent joint ventures, be it the Lumax Alpine, which is also sitting at a very robust order book, the Lumax Yokovo, and the Lumax Ituran. These three are the nascent joint ventures, and all three will substantially see scaling up in FY24 itself, because some of the order book will get executed. So I think we will be pretty much delivering on all, and that is going to be visible very clearly in our FY24 growth story. Mr. Mehta, you there?
Mr. Mehta, may we request you to unmute yourself?
Just one. On FY24 numbers, we should be around 3,000 to 3,100 crores of growth, including ISE.
I am not sure what the number would be, but definitely we will be having a significant growth. If you look at our growth in the last year, the growth was approximately 23%. So we will definitely be looking at upwards of probably 30% or plus growth in FY24.
That is excluding ISE, what you are talking about. Because ISE itself will be giving you a turnover of close to 750 to 800 crores.
Including ISE, the growth would be maybe almost close to 50% or maybe higher.
Yeah. And on the margin structure going ahead, how do we see our margins? Because we were at Q4 we were 8.5%, and for the full year, should we expect to be at 13.5% kind of thing?
Sure. I think if you look at FY23, we've already closed at 12.1%, where significant part of it was self-driven without ISE really contributing much. As I mentioned earlier, ISE continues to operate at a similar or a higher operating margin. So yes, I have always maintained that the team EBITDA is our first endeavor, and surely we will be able to expand margins both with the help of ISE and also with the traditional businesses, the operating leverage on higher revenue, scaling up of the existing joint ventures. So I think, yes, we will be definitely in the team EBITDA margins going forward in FY24 onwards.
Great. Wish you all the best. Thanks a lot.
Thank you.
Thank you. Before we take the next question, a reminder to all participants that you may press star and 1 to ask a question. Ladies and gentlemen, you may press star and 1 to ask a question. Our next question is from the line of Kanika Kothari from Kothari Securities. Please go ahead.
Yeah, hi. Good afternoon. So my first question was that we've seen fabrication revenues dropping from 18% to 13%. Is there any reason behind it?
Well, it's directly linked with Bajaj Auto. The fabrication is clearly driven by Bajaj Auto's own volume. So if you look at Bajaj Auto, it on a full year basis has degrown by 8%, but we are mostly on the export models, which have degrown at a much larger rate because of the external dynamics in these overseas countries. So it's a short-term, let's say, downfall. We definitely expect recovery in FY24 onwards, but there is no business loss.
Okay, sir. Got it. Thank you.
Thank you.
A reminder to all participants, you may press star and 1 to ask a question. Ladies and gentlemen, you may press star and 1 to ask a question. Our next question is from the line of Cheyan Bhada from Nirmal Bang. Please go ahead.
Good afternoon. So my question is on the Q4 revenue growth number. If we exclude the IAC contribution, then revenue growth would be around 6% year on year, which is comparatively lower than what our OEM clients have done. So any specific reason for the lower Q4 growth?
You're right. Actual Q4 of 22-23 would be about 6% on a year-on-year basis without IAC. The fundamental reason is based on our demand of the OEM. Bajaj Auto, which is the largest piece of the pie, also degrew. Specifically in Q4, they degrew by 4%. But again, certain models which we were on degrew much more. And also HMSI, if you look at their Q4, they have degrown by almost 25 to 27%. And again, a substantial part of our plastic business is dependent on HMSI. So just because of the two-wheeler volume drop, you do not see the, let's say, growth coming in Q4. Most of this growth has come in from the passenger vehicle segment, which has performed well and delivered on Q4. But again, it's a temporary phenomena. We do expect this recovery to happen in FY24, both on the two-wheeler and, of course, the passenger car vehicle itself.
Right. Yeah. In fact, sir, for April and May, Bajaj Auto numbers have been very good also. But one more observation is that for the full year, most of the passenger vehicle and two-wheeler OEMs have guided for high single-digit kind of growth number, whereas our guidance is much higher. I mean, so from where will this growth come from? How much, if you can divide the growth between standalone and the JVs, what will contribute to the overall growth of 30% that you are guiding?
So, number one, the growth for us is not necessarily just dependent on the volume. As I mentioned, there have been recent joint ventures which will be scaling up in FY24. So for us, that is completely new revenue. That is, let's say, new introduction on certain new models. So that is for us the first time business, which is not dependent on the incremental volume from last year to this year. Also, just to give you a number, without IAC, the growth is almost 15%, which we are envisaging between 12 to 15% for FY24. So again, it is in line with what you see from an OEM outlook. So if you dissect the growth in two buckets, one is with IAC and one is without IAC, you'll probably see a similar trend in without IAC piece. But again, as I mentioned, a lot of the joint ventures are scaling up, and that would add, and also the aftermarket, which is not really dependent on any volume indicators from OEM, will continue to grow at a handsome rate.
Right. Sir, so if what I have understood is correct, the standalone company will grow at around 12 to 15%, and there will be higher contribution from JVs, which will lead to much higher growth. That's correct, right?
That's correct.
Fine. Okay. Thank you, sir.
Thank you.
Thank you. Our next question is from the line of Shubh Jain from Emerge Capital. Please go ahead.
Good afternoon, everyone. Am I audible?
Yes, sir. Please go ahead.
My question is, so what is the net debt at the Concall level post the acquisition? And are we done with all the borrowings to fund the acquisition?
Shubh, we'll answer this question, but I'm not sure if you're on speakerphone, but it's a bit of an echo in your voice. So after this, maybe if there is another question, you could just come on the handset.
Net debt is around 147 crores. If I go with my debt equity ratio, it is 0.2%. IAC before because we have taken 375 CR loan of IAC. So that is why my gross debt right now is 407 crore and net debt is 147 crore. I think I am able to clarify.
Yes, sir. Thank you.
Mr. Jain, do you have any other questions?
No, thank you.
Thank you. Our next question is from the line of Abhishek from Dolat Capital. Please go ahead.
Sir, what sort of the synergy benefit do you see for standalone business due to the acquisition of IAC India?
Well, there's a lot of opportunity. I think number one, from a product supplier, we are obviously getting into a whole system supplier to the OEMs. There is obviously, as I mentioned, there will be a lot of synergies between the lighting and the plastic interior systems. Interior lighting is going to be an integral part of the whole interior solutions. So that is something which we are expecting to garner with the OEM's share in going forward. Also, I think there will be a lot of synergies in terms of cross-selling of products. We do a lot of, for example, the power window switches or the steering angle sensors, and the entire cockpit and the entire door panel is also done by IAC. So integration of these parts, also the gear shifter system, which goes onto the center console. So the idea is to move up the ladder instead of giving multiple parts, maybe speak with the OEMs and get a complete modular system to be supplied, and that's why we're going to go up the value chain with higher contribution per vehicle and also higher margins in the due course.
Okay. And are you paying any royalty fee to the IAC parent companies because of the technology?
There is no royalty arrangement, and most of the technology, innovation, engineering rests in India. Within IAC India, they have pretty much full competency and self-engineering capabilities, where we actually do a lot of design services for the IAC global facilities. So the dependability on IAC global is minuscule. Most of the innovation and engineering is done in-house within the IAC India Design Engineering Center.
And how much is the imported content in the IAC India, sir?
It's negligible. More than 95% of the value chain is localized in IAC.
And how is the mix export versus domestic, sir? In revenue terms?
Domestic play, we do some exports, which are about close to 5% or less than 5% of the revenues, but it's largely a domestic play with a strong presence in the passenger vehicle segment.
And is there any opportunity to enter into the non-automotive segment after the acquisition of the IAC India?
we will continue to focus on automotive, Abhishek. We don't have any strategic plans to diversify into non-automotive.
Okay, sir. And what is your consolidated margin guidance, including ISA India, for FY 24-25, sir? 24, sir?
So as I mentioned, I think if you look at the current numbers which we closed in FY23, it stands at about 12.1% at EBITDA level. My guidance is very clear that with the operating leverage, we will get into the teen EBITDA margins and hopefully sustain that. So probably between 13 to 14% is what I envisage.
So you're expecting around 150 to 200 basis margin expansion?
Yes, probably looking at around that expansion in FY24.
Okay, sir. And in oxygen sensor business, how is the outlook, sir? Any revenue from that business in FY23?
From which business?
Oxygen sensor.
So on oxygen sensors, if we please refer to the earlier investor calls, your company continues to maintain an order book of 125 crores, impacted by the regulation effect, but hoping to make up a bit of that revenue even in FY24. We are hoping to be doing about 20 crores revenue this year on oxygen sensors, and then we'll have to wait till April 2025 for the second oxygen sensor to come into the vehicles and then gain traction.
Okay. Thank you, sir. That's all from my side.
Thank you.
Thank you. A reminder to all participants, you may press star and 1 to ask a question. Ladies and gentlemen, you may press star and 1 to ask a question. Our next question is from the line of Aryan Saluja, who is an individual investor. Please go ahead.
Hello, sir. Am I audible? Hello?
Yes, go ahead.
Hello, can you hear me?
Yes, sir, we can hear you. Please go ahead.
Sir, actually, I have a question related to cash flow. So, as we have taken loan of around 300 crore on long-term basis and almost 130-40 crore is other financial liability in current liability. There must be some interest cost also expected in current year, and how you are planning to repay the current liability, as there is not much growth expected in PAT levels, as EBITDA is only 16% for IAC. And is there any chance of default on repayment of current liabilities?
So I think I've just explained. Right now I am having the cash and equivalent almost around 260 CR.
Right.
And the interest in this year was almost around 52 CR, which will go to 75 CR in the next financial year. And as explained, we have a robust EBITDA. So I think probably because the long-term loan is for 1 year moratorium, rather we are going to repay the loan back.
Okay. And is there any synergy benefits arising out of ISC acquisition?
Sorry?
Is there any synergy benefit arising out of ISC acquisition?
I think I just mentioned that 5 minutes ago. I'm not sure if you were on the call, but for your benefit, I'll just repeat that. I think there is a lot of synergy. Number one, there is a lot of cross-selling of products where we make a lot of products, for example, the switches, the gear shifters, certain steering angle sensors, and other internal parts. Now we can supply them as a system, as a consolidated system supplies to the OEMs on the door panels, on the IP. Also, the synergies are very clear that the interior lighting space is something which we know best, and we can now sell the interiors along with the internal lighting, where Lumax can play a vital role and IAC continues to front-end the customer with the whole internal dynamics. So these are two of the product synergies which I foresee in the very near future. Apart from that, obviously leveraging the relationships and the presence of Lumax across various OEMs, we will obviously open a lot more doors and try to grow the footprint of IAC with new customers as well as deepen the wallet share with current customers.
Okay. Thank you.
Thank you.
Thank you. A reminder to all participants, you may press star and 1 to ask a question. Ladies and gentlemen, you may press star and 1 to ask a question. Our next question is from the line of Harshil Shah, who is an investor. Please go ahead.
Hello, sir. Sir, can you explain the potential of Ituran and L-Sulfine? How big the JVs can be over like 3-4 years, and in the near term?
All right. So these are two technology-intensive joint ventures, and our company has very high hopes riding on the order book generation capabilities of these joint ventures. Ituran is telematics specific joint venture, whereas Al-Sulfine is supplying mechatronics products. The range is huge. Ituran gets into volume and value kind of a projection this year with a large global customer. We would not like to be very, very speculative, but we can assure you that triple-digit revenue for both the joint ventures is foreseeable as early as next 18 to 24 months.
And just to add to what Vikas mentioned, out of the 900 crore order book, almost 100 crores is between these two joint ventures of Lumax Ituran and Lumax Alps.
Oh, great, sir. And sir, you just mentioned 70 crores interest cost, right, sir? For FY24?
It is 52 crores. The next year would be 75 crores.
75 crores. Okay, sir. And sir, what is the size of tooling business of IAC? Because this turnover that you mentioned is excluding tooling business, right?
Yeah. It is at 140.
So the 635 number which I mentioned is excluding tooling, but the tooling revenue would be give or take similar in terms of a margins. So it will not really dilute the margins which I mentioned earlier. It would just pretty much stay in the same vicinity.
But like, can I take 50 crores, 50, 60 crores of base figure for FY23 for tooling?
Yeah, I think it's about 40, 45 crores of tooling revenue for FY23.
And sir, what the order book you mentioned is 500 crores for IAC, right?
That's correct.
Sir, thank you, sir. That's it from my side. Thank you so much.
Thank you.
Thank you. Our next question is from the line of Shubh Jain from Emerge Capital. Please go ahead.
Hello. So you mentioned that the interest cost will rise from 52 crores to around 70 crores, but 52 is currently the depreciation amount for this current year.
I'm sorry, it is 16 crores.
Yes. So it will rise from 16 to 70 crores.
Yes.
Okay.
Because the long-term loan of 400 CR, 41 CR will be there.
Okay. Thank you.
I'm sorry.
No problem. Thank you.
Thank you. That was the last question of our question and answer session. I would now like to hand the conference over to the management for closing comments.
Well, I take this opportunity to thank everyone for joining the call. We will keep updating the investor community on a regular basis for updates on your company. I hope we were able to address all your queries. For any further information, please get in touch with us or Strategic Growth Advisors, our investor relations advisors. Thank you once again. Stay safe.
Thank you. On behalf of Lumax Auto Technologies Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.